Stocks were up last week for the second week in a row on easing tensions in the Middle East. But over the weekend, peace talks between the U.S. and Iran broke down quickly, and the U.S. military moved to blockade the Strait of Hormuz. How will the financial markets respond? Let's talk market forces. U.S. Iran ceasefire talks ended quickly. The U.S. blockades the Strait of Hormuz. A major risk being largely ignored? Supply chain disruptions. Inflation spiked last month, driven by higher gas prices and tariffs. The Great Rotation, opportunities outside U.S. large-cap technology stocks. The S&P 500 was up 3.6% last week, marking back-to-back strong weeks for U.S. stocks and making the year-to-date return for the index nearly flat. Bonds were unchanged on the week. The commodities sector was down, largely on lower oil prices, which are back on the rise today. Gold was up, and Bitcoin had a strong rally last week. Ceasefire talks between the U.S. and Iran broke off yesterday after 21 hours of negotiation. Just for some perspective, the Korean Armistice Agreement, which ended the Korean War, was negotiated over 158 formal meetings spanning 2 years. The Paris peace talks, the negotiations that ended the Vietnam War, dragged on for 5 years, and the Doha Agreement, which ended the U.S. occupation of Afghanistan in 2020, lasted for 18 months. Neither side seems ready to end the war. Iran does have the upper hand from a strategic perspective, so there's no reason for them to make any major concessions. For the U.S., a negotiated settlement at this point would mean they're the big loser because they haven't achieved any of their primary objectives. The 2-week ceasefire is set to expire in 9 days on April 22nd. In the meantime, both sides are rearming their military assets. The Chinese are providing Iran with additional air defense systems and intelligence. According to the Wall Street Journal, the U.S. military blockade of the strait, quote, sets up a risky new showdown that could draw American forces into a prolonged struggle to control the strategic choke point while compounding the global economic damage caused by the conflict. A major risk is being largely ignored: supply chain disruptions. The closure and now blockade of the Strait of Hormuz presents a major risk to the global economy and the financial markets, and I think it's mistakenly being discounted by investors. The global economy functions like an inverted pyramid. A relatively small foundational layer of raw materials and energy supports a massive, complex economic infrastructure. If a critical choke point is closed for an extended period, it doesn't just cause a proportional dip in economic output, it triggers nonlinear cascading failures across global supply chains. Modern manufacturing is intensely interconnected and fragile. Missing a single tertiary component, whether it's a specialized semiconductor or a basic plastic, can indefinitely halt the production of complex goods worldwide. Because these manufacturing hubs rely on deep, specialized network effects that can't be quickly reshored or re-engineered, localized energy disruptions can rapidly force factory shutdowns across Asia, Europe, and the Americas. An energy deficit can spill over into agricultural inputs, threatening food shortages and economic rationing, particularly in third world countries and emerging markets. The biggest risk to financial markets in developed nations is an economic recession that would reduce tax receipts, forcing governments into an inflationary debt spiral where they must print money to cover their already massive interest expense and entitlement benefits. Inflation spiked last month, driven by higher gas prices and tariffs. The Labor Department reported Friday that consumer prices increased at a 3.3% annual rate last month, a huge increase from 2.4% in February. Impacts from the war with Iran and the effects of high tariffs continue to push prices higher. Energy prices were over 12% higher in March from a year earlier. Gas prices were up 19%, and fuel oil was up 44%. Even core CPI, which excludes food and energy, rose at an annual rate of 2.6% last month. The 1-month increase in CPI was the 8th largest spike in the last 40 years. Wall Street analysts have been saying inflation will moderate for months. They've been wrong. At some point, they'll catch on. Inflation has been moving steadily higher, and there's no end in sight, at least for now. Eventually, the credit and liquidity squeeze will offset higher energy costs, but that's probably going to result in stagflation or possibly a recession. That's data we'll get later this year, or maybe next year. Slower economic growth and structurally higher inflation are here to stay, unfortunately. The Great Rotation. Opportunities outside U.S. large cap technology stocks. We're officially seeing the start of a great rotation. For over a decade, U.S. megacap tech stocks have dominated market leadership, but the cycle is changing. The opportunity we see is in more global, capital intensive industries. At Alpha Rock, we've implemented a relative value trade where our short position in U.S. stocks is balanced by an allocation to foreign small cap stocks and positions in energy infrastructure and natural resources. Earnings growth is moving to companies with tangible assets and pricing power. Even the AI boom supports this, driving massive demand for the physical components of tech, like electrical equipment and advanced manufacturing, which heavily favors international companies and utilities. Ultimately, the most compelling part of this case comes down to valuations. Tech heavy U.S. equities are trading near the very top of their historical ranges, leaving them highly vulnerable to sudden business model disruptions. According to GMO, the company co founded by one of the greatest investors of our time, Jeremy Grantham, foreign stocks offer much more attractive valuations and are likely to outperform U.S. large cap stocks over the next 7 years. In our view, it's time to step away from the crowded U.S. tech trade. By investing outside the U.S., we may be able to add much needed resilience and value to our portfolios by seeking to capture the upside of this ongoing economic transition. To stay updated, please click like and subscribe. It helps me reach new viewers. If you'd like to know exactly how we're investing for our clients, download our recent quarterly investment outlook, The End of Easy Money. It's available at alpharockinvestments.com. Links are in the description.